Welcome to Green Rocks. Today, episode 6, tax increases. We're going to talk increasing taxes from frigid Nashville today. Nobody likes paying taxes. Let's face it, it's painful. That said, it's a patriotic thing to pay our taxes. When Greece had their financial crisis back in 2008, 9, and 10, it became an art form in Greece to avoid paying taxes. We can't allow that to become the culture in the United States. We need to pay our taxes, get it over with, and fund our government at an acceptable level so that our country can be stable and operate long-term without stress around financials. Today, given our large annual deficits, we're clearly putting our children in a place where the baby boomer generation, my generation, is taking more from the government than we're giving back. That's going to put our kids in a place where they're going to put in a lot of money and get a little back. And frankly, that doesn't feel very good to me. So let's talk about how we're going to increase taxes about 3% of GDP to make some progress towards a more balanced budget. So let's get into the details. We'll need to have a combination of tax rate increases and finding new sources of revenue to tax. We should also align any changes we make with future green energy use so that our solutions will last for a long time into the future. And finally, it would be great if we could incentivize actions to speed solutions to our climate challenge. Let's see if we can do that. First, let's review where we're at. Based on the year 2023, our total revenues were $4.439 trillion, and our expenses totaled $6.467 trillion, yielding a deficit of $2.028 trillion. Our goal is an annual deficit around 1% of GDP, and that would be around $250 billion. And just simple math, this would require a combined tax increase and spending cuts totaling $1.778 trillion. Our goal was to increase taxes from 17% of GDP to about 20% of GDP. That would require $750 billion of tax increases. So as far as tax increases go, the first one's the easy one. All we have to do is allow the Trump tax cuts to expire at the end of 2025. Well, this would seem to be simple since last year Congress did very little, and we've shown to be good at doing very little. This would seem a no-brainer. However, both parties are talking about extending these tax cuts, either all or part of these tax cuts. So we'll just have to watch that and see what they do. We have a $34 trillion deficit. It would be silly to extend any tax cuts. I'd also like to reinstitute capital gains to the pre-Bush, W. Bush era levels. If you remember, W. Bush did big tax cuts in 2002, and the previous to that tax cut, the capital gains for long-term were 20% for your first few capital gains, and for high earners, 25%. Those levels were each cut 5 points to 15 and 20% respectively. I would say let's just put them back where they were during the pre-Bush eras when we had budget surpluses and taxes around 20% of GDP. These are pretty straightforward so far. As far as new taxes go, I think we should legalize weed at the federal level. Many states are decriminalizing weed, and this would be a way for the federal government to get into the action, take away all the risks involved, and gain some revenue with a 10% sales tax at a federal level. Second one is pretty popular on the internet, and that's to eliminate the step-up provision for estate planning, and I'll describe that on the next slide. I'd also like to institute a very small sales tax on financial transactions, specifically buying and selling stocks and mutual funds and other financial instruments. This tax would be 0.2% for each transaction. So if I had a $10,000 mutual fund that I needed to sell to buy a used car, I would be assessed a $20 sales tax on that transaction. To give credit where credit is due, this idea came from Robert Reich. Robert's had several positions in 3 different administrations and has a good YouTube channel. I say Robert's very far to the left. I don't often agree with many things that come out of Robert's mouth. That said, I respect them. Frankly, that's a skill, to respect someone you don't agree with, that our Congress seems to have lost. Here's how the step up works. Let's talk about a woman who has $1 million of financial assets at age 50, and at age 90 she passes and she takes that same group of financial assets that used to be worth $1 million and passes them on to her heirs. Well, if those assets accumulated and doubled every 10 years, they would now be worth $16 million. So her heirs would receive $16 million of assets and would not pay any taxes on the increase in value from $1 million to $16 million, the $15 million. I would propose that their heirs would pay long-term capital gains taxes on that $15 million, which at the current rate of 20% would be $3 million, and at a 25% rate would be $3.75 million. One of the arguments against this, eliminating the step-up provision, is that her heirs might not have $3.75 million to pay the taxes, so they might have to sell the assets or some of the assets. And if that was a home and it was been in the family for generation after generation, I get it that that might be emotionally painful. At the same time, I struggle feeling bad for people that just inherited $11.25 million after taxes. This is a way that uber wealthy families continue to pass along their wealth from generation to generation. This is a good source of income, and we'll deal with some wealth inequality issues we have. In terms of preparing for the green future, the first one I want to talk about is the gasoline tax. We have a gasoline tax at a federal level, and the states also tax gasoline. That's why the price of gasoline varies in each state you drive through. Federal level, it's really hard to pin down how much that gasoline tax brings in, but it's in the $20 to $40 billion a year area. As we transition to electric vehicles, this tax will decline. And as usual, Congress hasn't talked about changing this at all. I think we need to get ahead of the game and add a $200 per vehicle license plate tax for all cars and light trucks, SUVs, passenger vehicles, if you will, and $1,500 per license plate federal level for 18-wheeler trucks. I'd leave the current gas tax in place, but I understand over time this revenue will decline. Also, for corporations, the tax cuts that Trump instituted were permanent, and they were really there were some minor provisions around R&D expenses that expired, but these were massive cuts. They lowered the top rate from 35% to 21%. Well, we're at near full employment, and the stock market is near record highs, which means profits are near record highs. One solution would be to add a carbon tax to corporations. We would simply calculate how much carbon the United States of America emits into the atmosphere in a year, figure out how much each business contributes to that, and then each business would then pay that percentage of the carbon tax amount. And so this would be a way to get corporations to help us pay for climate change solutions. These corporations would have new higher taxes, but they would also be able to reduce those taxes by implementing carbonless or carbon reducing strategies. So this is a wonderful way to drive some economic activity, get businesses to pay more taxes, and address climate change all at the same time. So how much would all these get us? Allowing the Trump tax cuts to expire would gain us 175 billion a year. Reinstituting capital gains tax rates 5 points higher than today would gain us 55 billion per year. Legalizing weed gains 10 billion. Financial transaction tax 148 billion, and the step-up tax elimination 12 billion. Preparing for the green future would also gain us substantial funds. A license plate tax would get us about $75 billion, and the carbon tax would get us $150 billion. All that would total $625 billion on an annual basis. So it's short of my goal of 750, but let's look at where this leads us. Taking those same numbers for 2023 and adding 625 billion to our revenue would put our total revenue at $5.064 trillion. Our expenses would remain constant at 6.467 trillion, leaving a deficit of $1.403 trillion. If you remember earlier in the session, our previous deficit was just over $2 trillion, $2.028 trillion. So we have made progress, and the number looks better, but it's not at our annual 250 billion per year goal. But we still have to talk about spending cuts, and we still have to remember as we go forward that we're a little short, 125 billion specifically, which is a lot short, on tax increases. So now let me summarize. So I think I presented a very pragmatic approach to raising taxes. Once again, nobody likes paying taxes. That said, it's the patriotic thing to do. In future episodes, we'll look at spending cuts. It's even tougher to pay your taxes when you feel like the other side is spending the money like it's candy. They're giving it away at Halloween. Money we all work so hard to earn. But first, we're going to have to go slowly with these tax increases. We could never implement all these tax increases in the next 2 years without trashing our economy. So it's probably a 5 to 10 year process to implement these tax increases. I'd have to have discussions with someone with expertise on economics at a governmental level to understand how quickly we could implement each of these taxes without damaging the economy. In future episodes, we'll talk about spending. But Al, you were 125 billion short and you didn't seem that concerned about it. Well, that's because I got an ace up my sleeve. I know how we're going to find this 125 billion a year and perhaps significantly more. It'd be a good thing to find more than 125 billion annual money as income without increasing taxes at all, without increasing tax rates and the tax plan at all. Thank you for attending. I look forward to future sessions where we dive into how to cut $1 trillion in spending from the federal government. Have a safe and great week.